the economy wasn't likely to stand higher interest rates too well, and that the interest rate would have to decline, which would, from my point of view, logically lead to an increase in gold price, and then recovery in the share price of gold miners. Lo and behold, occasionally I'm right, and it appears that I was right with regards to that call. I continue to believe that we are still in the first half of a gold bull market, and investors who are new to the gold market need to understand that 10, 15, 20% cyclical declines in secular bull markets are very common. They're unnerving, but the gold market doesn't exist for your stability and your peace of mind. That's not its function. So you need to accommodate these things, and you need to keep the faith and stay the pace if the underlying dynamics that cause the gold bull market are intact. To refresh people's memories with regards to those, they are, in no particular order, quantitative easing, which is counterfeiting. They are debt and deficits, the unsustainability of our level of government debt in the United States. Most importantly, they are negative real interest rates, the fact that other conventional savings products cost you money on an annual basis means that gold is competing with other savings instruments that are, as Jim Grant would say, return-free risk, an easy fight to win. And then finally, the market share, of precious metals and precious metals-related securities. That asset class comprises less than 0.5% of private savings and investments in the United States of America, down from a 3-decade median of between 1.5% and 2%. If, as I suspect they will, the economics and arithmetic of quantitative easing, debt and deficits, and negative real interest rates cause investors' perceptions to change enough that gold just reaches the 3-decade mean market share relative to other savings and investment assets in the United States, demand for precious metals and precious metals-related assets will triple from current levels. That's precisely what I believe is going to happen. People who are going to base their investment decisions on my beliefs are going to be very, very, very sad people over time. People need to have their investment actions rooted in their own beliefs. If people agree with my thesis that gold does well when people are concerned about the maintenance of purchasing power in other fiat-denominated savings products, then gold will do well, and probably do well sooner rather than later. But it's instructive, too, that people form their own paradigm, develop their own prejudices. And I would suggest that people, and perhaps you and I can do a segment on this at some point in time, people examine the Barron's Gold Mining Index, which gives you 55 or 60 years of history, so that you can see, and I'm not talking about technical analysis, I'm not talking about double tops or triple bottoms or cups and saucers. I'm not talking about anything like that. I'm talking about using the chart as a visual aid to understand, if you will, the DNA of bull markets and bear markets. The market for investment quantity, which is to say 1,000-ounce bars or above, silver market has never disappeared. It used to be that we could get filled in 5 minutes or 6 minutes from several sources. The idea that we had to go to Europe to get filled rather than going to Ottawa or New York or Chicago was brand new. We are finding more liquidity in the institutional market, meaning that, as an example, and I don't want to be quoted on this because I'm not involved in the process so much anymore, but meaning that rather than having to take gold out of London and fly it across the Atlantic, silver, we are able to find silver in New York or Chicago and truck it. Trucking it, believe me, is cheaper than flying it. So we prefer that alternative. We are just now beginning to see the premiums come down in retail physical product too, as some of the COVID-related shutdowns that have hit the refineries so hard are beginning to back off. The refineries, of course, can take 1,000 or 10,000 ounce products, melt it down, re-refine it, and turn it into 1 to 10 ounce product, retail products. So the tightness involved in retail products is beginning to decline, although there are still extraordinary shortages of popular products like Eagles and things like that. I mean, truly extraordinary shortages. And it's interesting to see that even as the enthusiasm around some of the Reddit crowd subsides, both retail and institutional demand for silver remains, by historic terms, extremely robust. When I am involved in visiting with some very large generalist institutional investors, the fact that they want to talk about silver, the fact that I don't have to bring up the subject of silver, but they say, rather, you have some experience with the silver market. Can you tell us about it? Can you talk to us about the thesis? Can you talk about the way that you see the silver market behaving in the last half of a precious metals bull market? This interest among very large generalist investors who can go to any investment class in the world that they want to, ones who might be more attracted to gold than silver because of its historic attributes. The fact that this interest is evidenced all the way from the largest generalist institutional investors in the world, all the way down to teenagers making their first investment or speculative decision through a cell phone informed by Reddit, tells me that the silver market has much more life than people are giving it credit for. And Dunnigan, I want to say, this doesn't have to happen, but I want to say that in my experience in the last two precious metals bull markets, silver has been a late cycle mover. The precious metals bull markets have been dominated in their first half by gold. But when the narrative takes hold and the momentum investor comes into place, that momentum investor shifts to silver, which means that in the last two bull markets that I've experienced, the latter half of a bull market has been silver dominant rather than gold dominant. My suspicion is that if this bull market, like its predecessors, is a decade-long affair, that we are a year or so away from entering the second half. And that could be easily, once gold reestablishes its momentum, silver dominant. Silver premiums are dropping, I think, for two reasons. I think the incredible rush that we saw into silver concurrent with the beginning of the idea of the silver squeeze, I think the bloom has come off that rose. I think you are seeing people in the silver market now who want to own silver for a variety of reasons, not merely to engineer a squeeze. The second thing is that some refineries, particularly in Switzerland, that were shut down as a consequence of COVID have reopened. And so there is a slight reduction of marginal demand at the same time that there's a fairly dramatic increase in supply, which is a good thing.